Today we sit down with Len Carby, investment advisor at Mandeville Private Client, to discuss his approach for building wealth. Enjoy the show. Okay, so we're here, Smart Money, the show with, of course, my sidekick Charlene and our guest today, Len Carby, a Mandeville Private Client, investment advisor. I wonder if maybe you could just give us a brief overview. Tell us a little bit about yourself and how you got to where you are, and a little bit of background and color.
Fantastic. Well, first of all, thanks, Greg and Charlene, for the invitation to join you today on this podcast and just using the opportunity to get to meet your audience. A little bit about myself. Been in the financial services industry for about 18 years, where I've navigated very challenging situations for clients, helping them with investment advice, retirement planning, estate planning, tax planning. But when it's simplified, my primary goal for my clients is to create wealth for them. I use various strategies and tools to be able to do that, but it's all about making them wealthier, growing their wealth, and keeping it.
Nice. Okay. Um, so for people who are just watching,
Yeah.
or just getting caught up in this idea now, Mandeville, which is owned by someone we all kind of know in the news and media, Michael Lee Chin. Um, a big name within the community. What can you tell us about, his influence on the company, and a little bit about who he is, and what makes like Mandeville sort of special in this arena right now?
So um, you mentioned the chairman of our company is Michael Lechin, is one of Canada's billionaires, who one of the most successful investment advisors in Canada, and has built a huge firm. Previously was called AIC and Berkshire, and he sold those over to Manulife many years ago. Was out of the Canadian industry for a little bit, but re-entered about 2019, rebuilding Mandeville, which is a smaller, more boutique firm of advisors. And what makes Mandeville really unique is our focus not just on uh, public equity and public fixed income, but broadening our shelf to include private equity, real estate, uh, alternatives. So you name the investment vehicle, we have a much broader shelf that we can use to meet clients' needs, because our client needs are a lot more complex than what public equity is able to meet. And if you think about how public equity responds to statements, earlier you were talking about the statements of political leaders, and you can actually just watch the stock market tick up and down
Yeah.
based on emotional, statements and geopolitical things. So it makes sense to have a portfolio that's a little bit more diversified, and maybe in privates allow for some of that diversification that doesn't impact or get impacted by geopolitical issues as much, but built on the fundamentals of the firm that you're investing in.
Right. Yeah, I mean that's something what we see very much on our side, on the real estate, the consumer real estate side. And it goes back, on our side really to consumer optimism, right? Consumer feeling and sentiment. So whether they make a decision to buy or sell, or to move up or to invest, really does rely heavily on how they feel about the market rather than the fundamentals of the market. Fundamentally, things have not changed, but their concern of, will I have a job in 6 months? Will my property sell, an adequate amount of time for me to go up and, move up the property ladder and buy? Will my kids be able to afford, to purchase? What do I do? What direction do I go in? Which is basically the basis and the foundation of what we're trying to do with this show. I guess the next question I had, like, who typically would be an ideal client for you at Mandeville? What sort of things would you be looking at in terms of, where you meet, and where you can service them, and where they can be an ideal client for you?
Mhm. So in building out my book of clients, I don't necessarily go based on a minimum based on client's assets. However, it does make sense that the client have some assets on the management, for
Right.
me to for it to be worth my time and effort to be able to build investment advice for them.
Right.
But an ideal client typically would be professionals. I find a lot of professionals are really skilled at their jobs, but that don't have the expertise in the financial planning space and often the time. And so having a partner to help them on this side of their financial journey and wealth building journey, it's where I find opportunity. And also with business owners. Business owners tend to have very complex tax issues related sometimes to transition out of the business. And they are often not aware of what the implications are at the time of transition, whether it is by sale of the property or if they were to pass it on to the next generation due to death. So often I find opportunity to help them how to meet the tax obligations that they could have with transitioning with at a much cheaper cost than what you would have to pay to CRA. And there are
Right.
strategies that we use to create that kind of plan for them. Maybe sometimes it's as low as 10 cents on the dollar in terms of using insurance as a means to do that. So in addition to the work I do with Mandeville, I do help clients also with their risk mitigation around taxes. And so I use also insurance products to be able to meet some of those needs too.
Okay, great. Um, I guess the other question I had was in terms of our clients,
Mhm.
we are predominantly working in the real estate space. Someone who, may have some cash, but also has, access to equity within their current home. Is that something that can be beneficial to someone like yourself or an investment advisor at Mandeville? And what would you recommend for someone to do to get into a position to be able to participate with Mandeville?
Well, absolutely. There's opportunity there. I find that a lot of individuals, because they're familiar with real estate, most of us will own at least our primary home, right?
Right.
And we have built some expertise around owning that real estate. And then they move on and they get a rental property. And so they continue to grow their uh, you know, portfolio of real estate. However, there are other investment instruments that way outperform real estate.
Hmm.
And so you could be missing out on significant wealth growing opportunity if all you're looking at is real estate.
Right.
And so if you have significant equity built up in real estate, it's maybe some time to think about diversifying your
Right.
portfolio. And diversification could mean looking at what other vehicles you have that could accelerate your wealth growing, much faster. At the end of the day, it's what do you want to achieve? Is it simply ownership of the real estate or is it wealth growth? And if it's growing your wealth, then clearly there are other opportunities that you can maximize outside of real estate. I'm not
Mhm.
suggesting that you shouldn't have real estate. I'm suggesting that there are other instruments that can way outperform real estate that you should be looking at.
Mm.
So the question becomes, if you are a homeowner and you have equity in your home, you're already that much farther ahead in creating that wealth and that growth. Would you would you agree with that?
Well, farther ahead, is relative to someone who does not own their home. Yes. So I would say absolutely. If you are already owning your home or several properties, you are further ahead than many who have not had the opportunity to start the wealth building journey. However, the point I was making is it should not be the only vehicle for you to grow that,
Right.
right?
Right.
And so
Mm,
there's
yeah.
opportunity to look at something else in addition to. And so equity built up in the home may not necessarily be used to buy another real estate and another, because there are other tools that you can use that will give you a
Right.
much better rate of return.
Right. And that makes a lot of sense. Like you may not want to buy a third or a fourth property. You may want to put it into a vehicle, and you would advise that person or those people what kind of vehicle they can use to get some. wealth building going on.
Correct, correct. And of course, it's all going to be based on suitability. I find a
Mhm,
lot of individuals will listen to, like, say, a podcast like this, and they think they're listening to, they're expanding their financial literacy. Yes, because this is sharing information. However, financial planning advice is always personal. So this is not advice to anyone. This
mhm,
is to pique your interest, to create awareness, but it's always best to talk with someone who can help figure out what is suitable for you based on your risk tolerance, based on your time horizon, based on their knowledge of the different products that could meet those needs. So there are a complex list of things that should be considered in what vehicle you would use for investments. And
right.
that's where working with a licensed advisor who can help you chart that path towards wealth growth and wealth creation is always going to make sense. You don't have to do it alone. You don't have to try and figure it all alone when you have a
Mhm,
partner. Just like, if you had a case to be tried in court, you wouldn't necessarily want to go and do that without a lawyer. It might make
right.
sense to bring a lawyer along with you.
Yeah.
You have a health challenge. You probably want to consult your doctor, right?
Yes.
And it's not that you can't, try some home remedies, but you always want to check with an expert in that area who can bring additional information, skills, resources to help you navigate where you want to go a lot quicker and more
Mhm.
successfully.
Yeah.
Yeah, and that's fair.
I mean, one thing that you just mentioned, very small towards the end, was quicker.
Mhm.
And I think that is a piece that a lot of people seem to forget.
Yeah.
And I don't put myself outside of that basket. I've failed in that department early on as well. The speed and time with which you have to devote to an investment makes a big difference. So like in terms of obviously real estate, there is a time horizon where you will purchase, and you hope to hold long enough that you will see price appreciation. In the case of a primary residence, you have the benefit of, tax sheltering opportunities and so on. In your field, is there a sort of time horizon that you would say that people should be realistically envisioning? A minimum of 5 years invested, or what sort of age group should people typically be looking at speaking to someone like yourself and saying, "Hey, this would make a great um, tool to put into my investment basket when I'm X." And I know all of, a lot of people will say that the best time to buy real estate is yesterday. The second best is today. Does that hold true for you in the investment world? Is it too late for someone at a certain age to consider this, or is this something that is open to everyone?
There is never a bad time to think about investing and growing wealth. Of course, the longer you have, the more time you give your assets to grow, the better it will be, right? I think about one of the things that we share with clients sometimes is called the three P's around, investing. It's predict, plan, and persevere. And I'll jump right to the last one. The persevere is actually staying the course. One of the biggest challenges that clients have is jumping in and out and trying to time their investments, right?
Right, right,
With real estate, they probably have a harder challenge doing it because it's such a hard asset and doesn't sell as quickly. But with other asset classes, they tend to want to invest for a short time and in and out and and they never can time it properly.
correct.
Staying the course with your investments in the long term, it's one of the things that wealthy people do, right? If you think about wealthy people like, Warren Buffett, they have held assets that they hold for years. And so you do want to think about, when you're thinking about wealth growing, it is not an overnight thing. It is not a get rich quick scheme. It is intended for you to buy good quality assets, which is one of the things that, wealthy individuals do. They know the asset class or know the investment that they're making very well. They study it inside out, and they hold it for the long term and allow the asset to appreciate over a long time and get the returns over time. And so depending on, to kind of narrow down to your question, it really depends on what the goal of that person is. If the goal of this particular investment is, let's say, your child's education, and your child is just born, well, you're looking at probably a 15-year time horizon that you're going to need to pay for university. You have a much longer time horizon. If the child is already 10 years old and you only have 5 years, you have robbed yourself of 10 years of not growing. And now you're trying to grow even faster. So you end up often trying to take more risk. Whereas if you had started early, that 15-year at even a moderate risk could have quite adequately gotten to your goal, right?
Mm,
So the quicker you get invested in some vehicle that's towards getting towards your goal, the longer that vehicle is able to operate, the more successful you're likely to be. Persevering is part of the, you know, three P's of success.
mm,
So, Len, my story is a little bit it's a little bit wonky in the fact that I didn't know anything about finances. I knew that I wanted to own my own home, and I put money in a pre-con back in, I believe it was somewhere around 1999.
Mhm.
And the pre-con finished and everything else, took possession in 2003. And I was about, I'm going to say mid 30s at the time, right? I didn't start investing until about a year later. And it was only because someone came to me and said, you should be doing this, this, and this with your money. I was broke. I was crying broke. I was so broke. It was unbelievable. But my $50 a month that I started with, you go through, because I had a full-time job, you go through the full-time job, you get raise upon raise upon raise. So I was able to put in more and more and more. And that's where my wealth wealth came from. I don't feel wealthy. It's
Mm.
there, it's put away, it's growing. I don't, like I said, I don't feel wealthy, but I know that there's something there for me when I retire, when I've moved on. How do you get people interested in wanting to do this at a young age like I was? Well, maybe kind of young, but even younger than me, because if had started 10 years before that, I would have been 10 years ahead, right?
You nailed it. You nailed it on the head, Charlene. It's part of the challenge I find often, and maybe one of the myths out there about wealth building is that you have to start off with a whole lot of money. If you have a very long time horizon, you can start with small amounts and grow. There is an old Jamaican saying. I'm going to give up a little bit of my heritage here now. It's the one cocoa. And probably that resonate with some of your listeners, right? The idea is a little by little and little that can add, and the longer you allow that to grow, the better it will be. So yeah, so the person who has just left university and start their first job, the principle of paying yourself first is, out of each paycheck, a portion should be set aside for long term. You can't spend all of what you earn, because there is going to be a non-earning period of time in your life. And so starting small but staying consistent, staying and continue to contribute over time is what many have done, and has allowed them to, be in a position to purchase their first home,
Mhm,
right? And then leverage that first home to purchase another home, or leverage that to invest in something else. So the sooner you can start in investing, like I said at the beginning, there's never a bad time to start. The earlier is the better.
mhm,
Doesn't require
mm.
a lot, often, especially if you're younger. Start now. But financial literacy, unfortunately, is not something that, in our community is very high. And so opportunities like these, I think what you're doing here on Smart Money is a great opportunity to create awareness about the value of start thinking early about your wealth building strategies and wealth building journey, and how you get help towards doing that sooner than later.
mhm, mhm,
Yeah, I mean, one of the challenges we face and we see is that the people we do come across have oftentimes not started early. And so now they're sort of in the midway point of their life journey, trying to make up for lost time by doing exactly what you mentioned, which is chasing something that is flashy and sexy in terms of an investment, rather than stick to the fundamentals and the basics with and add discipline to that idea. Um, and I guess that is the struggle. You can jump in as well, Charlene, but that is the struggle that we see is people think that everything or hope that everything that comes across their desk as an investment is quick, it's easy, it's incredibly lucrative, which again, after many years on this planet, anything that's, again, I'll use, some sayings from when I grew up, easy come, easy go,
Yeah.
right? So if it's too good to be true, you always get that person come around 18 months or 2 years later saying, oh man, I can't believe I got burnt on that investment. Well, easy come, easy go. It was too good to be true, right?
Yeah, the MLMs are really probably not a good idea.
Yeah.
With our community being the way that it is, so nobody got a course in finances, right? I didn't have that growing up. I had people around me who said, "This is probably a good idea. You should probably do it," which is when I went out and did it. But we never learned that stuff in school. We never learned it from our parents. Our parents came here from wherever, whatever Caribbean country it was, and they worked hard. They got a home, they took care of their children, and they instilled that in you. So, for whatever reason it is, you were told, get a good education, go out there and get a job and work hard and stay there till you die or retire, whichever one comes first. And then, you know, what happens? What happens then? Like, we had no clue. Had to figure this out for myself,
Yes.
right? And it was difficult.
Which I think you are kind of leading the conversation to another point that comes to mind is around, these financial conversations that we need to be having in our over the kitchen table, over
Mhm,
dining table. When we get together, you get together and we can talk politics, we can talk, community, we can talk about many things, but we often don't talk about money.
mhm,
And being willing also to share with others the strategies that we're using towards success. We tend to hold conversations about money very close to our chest, and
don't
even our
don't
parents,
yeah,
right, who have done well.
mhm,
The children don't get involved in their money arguments. It's not your place to know. And I think we have to break some of these, cultural and community things around how we, interact with money and how we talk about money and be more open to have these kinds of conversations to create financial literacy, not just, in a classroom, but over that, kitchen counter or over that, dining table, in
mhm,
those moments when you're talking about some of the decisions you had to make, some of the lessons learned, through investment or lack thereof. Pass on that information to
yeah,
the next generation so that we can build the muscle around investing and around financial literacy within our families also and in our community.
mhm, absolutely, I agree.
Well said. Yeah, I think, that tends to be the challenge, and to what Charlene, led in with. I think one of the problems is that, our parents all came with an immigrant mentality of, get here, land, and work hard. And you're up against people who've possibly been here for several generations who have been able to sort of navigate and understand the landscape a little bit better, a little quicker. And so they've got a little bit of a sort of an intertwining with the systems that we maybe didn't have. And I think now, looking at us as second generation, I guess, to Toronto and Southern Ontario and Canada in general, we are now started to take on some of these ideas of, okay, now that we're here and we're not really planning to go somewhere else, or our kids are not planning to go somewhere else, we really need to start thinking about making these positive changes and looking around left and right. How did these people do what they did?
Yes.
We need to understand that, you know, one of the things that came to mind when you were speaking, Len, is the ability of the community to be self-sufficient, not necessarily, you know, in a negative light, but in a way to be able to say that, you know, when I spend this dollar in the community, I can see it flow to other entities, other small businesses, other ways that, again, I'm not necessarily spending, but I am investing that money within the community, and that community will come back and serve me again, and provide and invest and spend with me again. I think that's sort of a powerful piece that unfortunately the community doesn't have a lot of you know, at the moment.
Mhm.
I hope that we do strengthen and get to learn from each other and so on.
Yeah, and I do have, regular conversations with my clients and in community in general about the importance of building generational wealth.
Mm.
And that often resonates with individuals, but the practical piece of what to do to create that, then they pause. So for
Yeah.
example, building what generational wealth for yourself and your family could simply mean having a plan in place so that CRA gets less of your estate when you pass away.
Mm.
Hmm.
That's building generational wealth because more goes to your children and your loved ones. And without a plan, a huge part of the wealth you have created is going to go away to taxes. So why not create a plan that allows more of what you have built and worked so hard for all of those years to stay within your own family?
Yeah.
And by doing that, you're actually building your community also. But often the next step of going beyond just listening to the podcast or listening to a presentation. We are not short of going to presentations in our community. We go to a lot of presentations, but we do nothing, we don't do enough with the information we get.
Mm.
We take good notes and it goes on our desk or in a drawer, and we don't take the action that's required. And so that I think is one of the challenges I think in our community where we have to be willing to take the next step around how do I use these practical things. And for me, I think success is, a fairly simple formula. It's finding someone who is a mentor who has been successful, follow their formula and don't change it. You can actually be
Mm.
very successful with that very principle, right?
Yeah.
Mhm.
But very often is that we find that someone who is successful, we see what they do, and we just watch what they do. We don't follow what they do, right?
Mm.
You have to be prepared to follow a kind of a framework, if you will. And if you follow that framework for success, then you're likely to receive good results. Not everything you're going to touch is going to turn to gold, but performance is also an important part of what you're trying to achieve. And that's one of the specialties of, my team over at Mandeville, where we aim to give you great performance on your investments, right? It's not okay just to be comfortable with, going to one of the big banks, and I won't name any of them. I used to work for one of the big banks too, right? And I know when clients would come in, we tell someone, well, you're in a balanced portfolio and you're getting, 6%. Wow, phenomenal. You should be happy with that, right? Well, what if you were getting 10%? How much quicker could you have achieved your goal, right?
Mhm.
And it doesn't have to mean taking that much more risk. It may mean finding the right instruments that are suitable for you that give you better performance. And so the advisor you work with is also important to make sure
Mhm.
that you're maximizing the returns. I'd ask you this question. If you went in to do a portfolio review and your advisor said, well, you did, 5% last year. Um, and you may think, well, that's great. At least I didn't lose. I'm great with 5%. But then your brother right next to you says, well, I don't take any more risk, but I got 10%. Would you be curious about what your brother is doing?
You should be.
You should be.
Suspicious.
Right? I'm curious. That's where I think, we have to be willing to explore more. And that's the part about building your financial literacy then, understanding what are the options that are available to you for increasing the performance of your portfolio, still long term, all the principles remain in place. I'm not talking about speculative investments at all. I'm just saying performance is an important part of your portfolio that you should be looking at and making sure you're maximizing the opportunities for growth in that portfolio. And that's why, my team and myself over at Mandeville, we actually put it in our tagline. What we do is create wealth for our clients. There are not a lot of firms that will boldly say that. We make our clients wealthy. So if you want to learn about how we do that, then happy to have a conversation that's more tailored for individuals who may be listening and just curious about what our approach is.
Excellent. Oh, I think that's an excellent sort of recap of, the conversation we had, and a good way to sort of um, tiptoe our way out of it. But before we do, one thing that did sort of catch my attention as you were speaking there was the difference between the big banks, who are not really in the business of wealth building. They'll try and do their best to keep their eye on your money,
Mhm,
as opposed to someone like yourself at Mandeville, who is an active investment advisor, who, you are active money management professionals, completely different ball game, which is why you can talk about the 5% versus the 10%.
mhm.
Yeah. So on that note, I think that was an excellent conversation, a good sort of segue into the world of Mandeville. And we'll be sure to link all your contact information at the end of the video and in the description. Um, but do you have any other questions, Charlene?
I got nothing.
No questions? Well, listen, I like to finish kind of where I start, with a huge thank you for the opportunity. Listen, the fact that, you've created this platform and you're trying to spread, financial literacy and creating awareness for people about money, I think that's a phenomenal thing. And I'm, thrilled for the opportunity just to be able to connect and share some thoughts with you, and happy to share anytime, you guys would like to reach out again.
Excellent.
Thank you, Len.
Okay.
I appreciate this. I know Greg does as well, taking your time out of your day because it seems like time is flying these days. I don't know what, it's already the middle of January. It's just crazy, but we appreciate you talking to us about wealth building and money and everything else. And hopefully, everyone will appreciate this podcast for what it is.
Yeah. Yeah, we're
Awesome.
actually just getting started, just getting off the ground, but to have, people like you in our corner early on, sharing this content. I'd love to have you on again and dig a little deeper and yeah, see where this goes.
Wonderful. I'm looking forward to it.
Onwards and upwards. Thank you very much for your time, Len.
Thank you. Thank you. Take care.